Happy Monday, everyone. Welcome to The Street Live. I'm Jeff Marks, standing on the floor of the New York Stock Exchange with Jim Cramer. Jim, we got a little bit of a mixed day today. We are seeing big rally in financials and energy, where a lot of growth in some of the more defensive staples, utilities, we are seeing them lagging today. So what do you have your eye on?
It's rates. So long as rates go up, we see what's going on. The rates go up, people buy banks, they buy the oils, they buy the travel, they buy the leisure, and they buy the industrials, the latter aided by perhaps an infrastructure bill. And the bifurcation is so stark. You know, we happen to own a lot of the big technology stocks, but we've been buying the companies that are involved with growth. Just as we bought Disney. I mean, we're pivoting in order to be equal to this. The question is, do we pivot enough that we need more banks? And I'm not sure yet.
So that's part of the barbell, right? Barbell between some of the reopening trades, like a Disney.
One thing you don't do is you don't back away from Amazon because of an earnings note from Morgan Stanley. There is nothing in the Amazon story that tells me they will really have a lot of higher costs, because that is a company that is built on the notion that they can get everything down in cost by using automation. So I'm fine with that. I think Microsoft is doing terrifically. Facebook's the one I'm worried about. And the reason I'm worried about Facebook, we don't own much Facebook, is because I think people are fed up. And there's going to be a momentary hit if they don't. Why did they blink on kids? I think they blinked because they're getting bad feedback from advertisers. And I do feel like if it weren't selling for 25 times earnings, I would just take that profit.
All right, and I should correct myself. Disney's more of a hybrid reopening play between its parks and its streaming business.
Disney, to me, is a travel company. It's a travel company because, in the end, the theme parks make a huge amount of money. Now, what's so good is that it's revealing that Chapek is a good operator because they had the best movie. Now, you can say that movie was under Iger when it started, but I'm starting to think that that's a good transition. And it seemed rocky at one point. Maybe it's not so rocky, because what's happened is that you're seeing Chapek, it's not hung up on ESPN. They're hung up on Disney Plus, and they're trying to switch that and make it so that, look, the theme parks are open, the cruises are open, people are shopping again, people are going to Disney. Disney is a destination for when the economy is doing well, and that's why that stock is coming right back from where we bought it. Nice buy by us.
Yeah, that was last week, and we talked about Disney a lot more in depth on last week's Action Alerts Plus call.
We told everybody from our conference call, this is the one we will buy if it gets hit, and that's what we did. We're true to the call.
All right, Jim, I want to turn our attention to oil because we are seeing WTI break above 75, the highest levels we've seen in quite some time now, multi-year highs. So what are your favorite names in the oil sector?
Chevron for large cap and dividends, still cheap. I think the world of Pioneer. Devon's my number one name. I think it's amazing how Devon's doing. Speculative is Tellurian, $3 name. I think that's really important that people have a speculative. I just felt that Conoco did that incredible deal last week with Royal Dutch. It's going to give them some tremendous leverage. I think Diamondback, because they now have discipline. Devon, because it's going to have an amazing dividend, because they do a hybrid dividend. Look out. That's Rick Moncrief. He's brilliant. That was a combination of WPX and Devon, and amazingly, even though Devon was much bigger, Moncrief became the CEO.
All right, Jim, we also should turn our attention to Capitol Hill. We still have the debt ceiling looming this week, and negotiations continue to go back and forth. I know last week you said you were hopeful that Nancy Pelosi would be able to strike a deal. So what do you got watching now?
Madam Speaker has said over and over again, she wouldn't bring anything to the floor unless she has the votes counted. She's an excellent vote counter, so I think it's all systems go for infra, which means buy Nucor. Buy Nucor aggressively, actually. Aggressively.
By Nucor, so infrastructure trade, so a lot of those, Martin Marietta, that's always one of your favorites in there as well. Any other potential picks?
I have to tell you that as much as you may not think it's a great operator, people are watching. Cleveland Cliffs, the stock is selling it. God bless you. Selling at 2 times earnings. It's pretty amazing.
All right, Jim, let's also turn our attention to overseas. There was an election in Germany overnight. I don't know how close you are following it, but we did see a nice rally in the German markets on anticipation with the parties that are leading. We might see more spending, and more spending tends to see a rise in the stock market.
The Liberal Party is the conservative party over there. And so the Liberal Party did quite well, and that's very good for wealth. You want to consider the fact that the Liberal Party did so well that they will have a chancellor. Now, we don't know the chancellors, that the chancellor will not be someone who is further left than Merkel. Merkel's reputation has been cemented by the idea that Germany is the wealthiest country in Europe and doing quite well. And I salute her for that. I think that under President Trump, we lost a lot of leadership to Merkel. Now, I know that there are plenty of people who are in favor of President Trump, and I totally get that, but Merkel led this, the worldwide stage, and she did not take a stand on China, which to me is very bad. She should take a stand on China.
All right, Jim. Now, also last week on a Real Money column, you described this notion of how sometimes analysts may miss by a wide margin, and because one reason for that could be because they don't seem to have a full real-world perspective. And you used Salesforce as an example here, because after that analyst day target, we saw the stock shoot up. I think it rallied about 8-10% last week off of that higher revenue revision, strong margin outlook. Big TAM, good details around Slack. So what makes you think that sometimes the analysts don't quite get the full story?
I mean, look, I started the street and I brought in Salesforce. We did incredibly well. And Salesforce was ripped out by an ill-advised CEO. And then we put Salesforce back in and the numbers soared. And Salesforce is a return on investment product. We also had Slack. Slack is great. Mark Benioff, when he buys companies, is immediately derided as someone who's desperate for organic growth. Well, if you have margins that are going up like this, that means you're not desperate for organic growth. It means you're making acquisitions that are complementary to your current business, which is what he does.
All right. Finally, Jim, last week you did call this current week the calm before the storm. Calm being not a lot of earnings reports, although we do have Micron, and the jobs report isn't this Friday; it's the following Friday. So let's just get your thoughts on the week ahead and what to look for in the future.
Well, I mean, I think it is a calm week because Micron is down. Micron's interesting. It reminds me of FedEx. It's been down, and yet when they report, it'll still go down because people have to cut numbers. And then it might bottom. Why I say calm before the storm is the employment number is crucial because we've got to figure out, also wages, how much an employee costs. Because when we see these labor shortages, they're a combination of fear about COVID and the idea that someone else is willing to pay more. Now, I saw in Bucks County, I saw $21, $22 come on, you can get it per hour. And that's not bringing people in. I think these companies are going to have to start thinking about paying $30 an hour if they really want people to come in from the sidelines. And I don't think that companies are ready for those costs. So my biggest concern is, and one of the reasons why I don't want to abandon tech, is that tech has got costs under control. And a lot of other companies do not have costs under control.
Yeah, and a company like Amazon that you mentioned earlier, I mean, they can afford those wages. It may be a hit to EBITDA like Morgan Stanley mentioned, but the ports is a different story right now where the big Wall Street Journal article this morning, 60-70% they're operating at, and as you mentioned, you do have Lance Frinson, CEO of Union Pacific.
Yeah, I mean, again, people work and expect to be paid more money and are basically saying, listen, you don't pay me more money, I'm just not going to do what you want. This is a big change in America. It's a shift of power between labor and capital, and that's because we finally, maybe it's because we've cut down immigration for a long time. Maybe it's because of death and fear of it. But whatever it is, people are not coming in off the sidelines. We thought that they would after the unemployment benefits expired. They're not coming in. And maybe when kids cycle through COVID, maybe mothers will come back to the workforce. But I've got to tell you, people who are thinking that they're going to go back to $18 an hour are gravely mistaken in most parts of the country.
Yeah, that jobs report, not this Friday, next Friday, definitely going to be a big thing to watch. All right, we're going to leave it right there for today. We'll see you tomorrow.